Good afternoon, ladies and gentlemen. My name is Michalis, and I'm one of the market analysts here at HF Markets. And I'd like to welcome everybody to a very interesting live analysis webinar. Now, these webinars are very different to the traditional webinars that we do here at HF Markets. Why? Because, ladies and gentlemen, today we're looking at a live analysis of the live real-time market. So we're going to be looking at how to build biases throughout the day, how to determine what kind of domino effect is likely to be throughout the market, looking at how to establish what type of price sentiment there potentially is going to be within the market as well. And of course, something extremely important, we will also be looking at technical analysis, be looking at signals and indications as well. So this is what we're going to be looking at throughout the market today in real time, real signals, indications live on the MT5. But before we start to look at that, because we've still got 14 minutes until the US release their purchasing managers indexes for both the service sector and also the manufacturing sector as well. What I want people to understand is before the announcement is made, how can we build a bias within regards to the price condition, within regards to the sentiment within the market? Depending on what asset we are looking at, how can we determine before the event has even taken place whether there's a strong sentiment towards the asset, a poor sentiment, what kind of price influence is there throughout the market, and how can we obtain signals before the event has even taken place. And this is what we're going to be doing in the very first 10 minutes before the announcement has even taken place. So the first thing I want to do, ladies and gentlemen, is look at indices. Why? Because these are one of the most traded financial tradable assets worldwide. So, for example, looking at the NASDAQ, looking at the S&P 500, looking at the Dow Jones. But even for individuals that are trading, should we say, stocks and indices which are less traded, more thinly traded, should we say, for example, the Russell 2000. This is, of course, something which also can apply to these assets as well. So before we look at the announcement, let's get a good bias of what potentially is going to take place throughout the session today. Now, the first thing I want people to understand, here we're looking at the NASDAQ, but we will look at also other assets as well. So here what we need to understand is when we're looking at the NASDAQ or any equity-based index, is that there's of course multiple stocks that form one asset which is tradable. So it's one sole asset tradable, one single price. But within that fund, within the index, there is multiple stocks. Now, all of these stocks don't have the same influence over the index. Some of them have a larger influence. So, for example, if you're looking at a stock which has a high influence and it's moving upwards 1%, and then you've got another stock which has a low influence and it moves down 1%, then of course the upward price movement will be considerably more, and the asset itself will of course increase rather than stay unchanged or decrease. So all stocks are not equal. Some stocks are more influential. Why? Because they have a larger influence. Now, within the financial trading market, this is what is known as weight, component weight. So basically, the higher the weight, the higher the influence of the asset. Now, yes, we of course look at technical analysis. Yes, of course, we also look at fundamental analysis. More experienced traders, they may be looking at things like delta statistics, cumulative delta, volume profiles. But either way, no matter what our approach and methodology is, there's massive benefits to also looking at the components. And there's different theories and ways which the market look at this. So, for example, ladies and gentlemen, here what we've got is basically all the stocks which are within the NASDAQ. And basically, what it's showing is the percentage of the portfolio which is made up of these stocks. So, of course, the larger the percentage, the more influence they have over the price. This is what is known as weight. and you will notice that it's a table and each stock is ranked. So for example, first, second, third. So of course, first is of course the most influential stock. Now, the most important thing is this here, ladies and gentlemen, the price movement. Now, there is different theories within the market. I will confirm to you the main three theories that investors actually look at. Now, the first theory that investors look at is that, of course, they cannot concentrate on the whole of the stocks. And of course, if you look at the whole of the NASDAQ itself, if you look at the whole of it, of course, the stocks which are smaller companies and also influenced by different conditions within the market, these stocks here may be in the red more often. But of course, it has a minimal effect over the NASDAQ. So there's disadvantages at looking at the NASDAQ overall. So what are the three theories? Now, one very well-known theory is solely looking at the top 10 most influential stocks. Now, what people want to see is they want to see 70% of these stocks increasing in value, or 70% of the stocks decreasing in value. So, for example, if you're looking at technical analysis, you're looking at the charts, and you've got an indication that the price is going to increase, you would come here and you would check that 70% of the stocks are also increasing in value. So, for example, today, so far, and of course, this is within the pre-market trading hours, so we have to keep in mind that potentially this is going to change very soon. Of course, we can refresh this because the market has opened now. People want to see that 70% is increasing in value. So, for example, you can see now that it's changed. If we look at the top 10, we can see Tesla is declining, Costco is declining, and Apple is declining. So we can see seven out of the 10 are increasing in value. So if we're potentially getting indications that the price is going to increase in value on the NASDAQ, then of course this is a further indication. In a sense, it's backing up what is provided within the market. So this is theory number one. Theory number two, which individuals can also use, is instead of looking at the top 10 most influential assets, what they'll do is they'll look at all stocks which hold more than 1%. So that's the top 24 most influential stocks. And they want to see that, again, 70% of those are increasing in value. If we're currently getting a buy signal, if we're getting a sell signal, we want to see 70% decrease in value. So for example, we've got 24. What we can do is also get the calculator out to help us. Here we go. So from the top 24 most influential stocks, we have 1, 2, 3, 4, 5, 6, 7, 8, 9, 10 declining. So we've got 10 out of 24 declining. So that's 41. So that basically means that 58% are increasing in value. So there we can see, for example, we don't have enough stocks increasing in value for us to back the signal that we're going to see a decline, an increase within the market. If 70% of those were decreasing in value, then that would be an indication that the price is going to decrease. Now, the third and less well known and less used is that investors will look at the top 40 most influential stocks. Okay, so this is one thing that individuals can do before the market events, whatever the events may be, is actually released. They can come here and look at the number one, the performance of the top 10 most influential stocks. To see what percentage are increasing and decreasing in value. Number two, they can look at the top 24, basically all stocks which is more than 1% weight. Of course, today's top 24, as is volatility within the market, of course, the weight will also change. So for example, tomorrow it may be 22, the next day it may be 27 stocks. That of course will keep changing. And of course, looking at if most of those stocks are increasing, most of them are decreasing. And then a lesser known scenario is looking at the top 40. So this is one thing that individuals can do before the announcement is made. Now, if we're looking at that, looking at the top 10 most influential stocks is definitely indicating that the price of the NASDAQ is going to increase in value. Of course, so we need to look at the announcement to determine that. If we're looking at the top 24, so anything above 1%, we have indications that we don't have a signal that the price is going to increase, but neither do we have a signal that the price is going to decrease. And there's a slight tilt towards more a bullish market because, of course, 58% is increasing. So it's a slight tilt towards a bullish market as well. Now, another thing that individuals can also look at is the SME Fed Watch tool. Now, this basically, you can see here, there's multiple months. This will give you all the months and the date where the Federal Reserve will actually release an interest rate decision. So we can see the next decision is in June. The decision after that is July, then we've got September, November, December, and so on and so forth. Now, what this basically does, ladies and gentlemen, is it gives you what economists within the market believe is going to happen to interest rates. So, for example, if we're looking at June, we have 95%, almost 96%, actually believe that interest rates will remain the same. Whereas we've got 4% that believe interest rates will actually decline. So, almost the whole of the market believe it will remain unchanged. Then, if we look at July, the main scenario, 82%, so very high, believes that it will remain unchanged. If we're looking at September, we have 49 in favor of a 25 basis point cut, 41 in favor of it being unchanged again. So that's almost 50-50 as well. That's not a guaranteed interest rate adjustment. So why is this important to the stock market also? This is also important to the stock market because the lower the possibility of an interest rate adjustment. So, for example, maybe after the announcement is made, the PMI is released for the US. If this suddenly goes from 49 to 45, and this suddenly goes up to 45 as well, so it's a higher possibility to there not being an interest rate cut in September. So more hawkish Fed, less interest rate cuts in 2024, and also a delayed interest rate cut in 2024. This is negative for the stock market if we're following traditional economics. Whereas if we're looking at the exact opposite, a higher possibility of interest rates declining, then that's positive for the stock market. So this is something that we have to keep monitoring as well. And this is directly from the Chicago Exchange, ladies and gentlemen. This isn't from a platform. It's not from a broker. This is directly from the exchange. The other thing people need to make a note of, because it can have a big influence within the market, is bond yields. Now, if bond yields decrease, so we can see here it's only a slight decrease. This isn't really enough to have an influence in the market. But if bond yields decrease, it's positive for the stock market. This at the moment is positive, but only slight. And I say only slight, very simply, ladies and gentlemen, because it's only slightly lower at the moment. So that's not really going to have enough influence in the market at the moment. And then, of course, you're looking at the US dollar as well. The US dollar is declining, which at the moment is declining. Sometimes it can make the stock market more attractive for foreign investors. Why? Because for foreign investors, it very simply means they can get access to that investment using less of their currency. So it's cheaper for them to purchase. Also, a lot of investors very simply look at it basically as a fact that if the currency is low, then they can look at entering and investing into the stock market. And also, if the currency increases in value because it was previously purchased at a low rate, then they can positively benefit from the stock market and also positively benefit from the rise and the rebound in the currency as well. So we do have some indications that the price may potentially increase, but that all will be in vain if the PMI is not going to be in the favor of the US dollar. So let's quickly refresh our calendar and we'll set our calendar up. So we'll click today, we'll remove all countries and we'll look at the US alone. Let's click OK. Right, here we go, ladies and gentlemen. We have a higher PMI for both manufacturing and services as well. Now, I haven't looked at the chart yet, but this can have actually a negative effect on the stock market. And we spoke about this actually within today's market analysis as well, ladies and gentlemen. The fact that if we've got a negative PMI, and also if we look at the fact, and I'm mentioning this throughout this morning's analysis as well, if we're looking at the fact that the Federal Open Market Committee released released their meeting minutes, they actually were very hawkish. There was actually members, for example, Mr. Kashkari and Mr. Bostic, which actually said that they would consider another interest rate increase, most likely 25 basis points. And they would do so because of the very sticky level of inflation, the fact that inflation has actually increased in value. And that was even before the latest inflation announcement. We also have to take into consideration that the stock market very quickly increased in value. So is that going to trigger a lot of people going to start cashing out as well? So this is things that individuals need to take into consideration. Of course, if we're looking at the stock markets as well, again, we can see more reds here as well, ladies and gentlemen. So this is becoming more of a 50-50 scenario here. If we're looking at the most influential stocks here. So if we're looking at top 19, we have 1, 2, 3, 4, 5, 6, 7, 8, and 9. So almost half of the most influential stocks are actually decreasing in value, including the second most influential here. Okay, the second most influential is decreasing in value. So that's a big factor, ladies and gentlemen, as well. So there is here some signs, even though that maybe longer term signals is that the price is going to increase, that there can potentially be a small decline. Let's get our MT5 up though. I've got it on another screen. There we go. So here we're looking at the NASDAQ. The NASDAQ has declined. The NASDAQ really gained the momentum here, ladies and gentlemen, after the PMI announcement. Why is the PMI announcement negative for the stock market? Most likely positive for the US dollar, even though we saw the US dollar was decreasing in value. We can see after the announcement over the past 3 minutes what's happened to the US dollar as well. Let's actually go to the US dollar before looking at the NASDAQ again. There we go. So we can see the US dollar since that announcement, we were all the way down here very quickly, just within 3 minutes, increased by 0.28%. So this is exactly what I was referring to. Now, why is this negative? People probably are saying, a strong economic expansion is positive for the stock market. For companies, yes, it is positive. We cannot deny that. And it is ideal, but it depends on the circumstances within the market and what investors are looking for. And at the moment, the monetary policy traditionally is in restrictive territory. It hasn't, though, had any effect over demand. Inflation has declined, but it's declined because of better supply routes. Whereas it's not being triggered by lower demand and lower consumer demand or investor demand, or should we say, a more contractionary sentiment by very large institutions and companies. So this was the issue by the Federal Reserve and the Federal Open Market Committee, which was mentioned within the meeting minutes. So, ladies and gentlemen, this is why we're seeing a decline, because the fact that we're getting a strong PMI is actually saying to the Federal Reserve, you're not having an effect on consumers, you're not having an effect on demand. The fact that you've got a restrictive monetary policy isn't restricting the economy, and it's not in any way, shape, or form actually risking a harder landing. in other words, economic contraction or a recession. So, therefore, if you wish to increase interest rates, you're more than welcome to do so. This is what the PMI is saying to the Federal Reserve. Now, somebody here is asking, why is higher interest rates negative for the stock market? I can see somebody's written that here. So, the reason why that is, ladies and gentlemen, is very simply because when you got higher interest rates, there's a higher possibility that demand will decline. If demand is going to decline, then of course it will affect all of these 100 companies within the NASDAQ. In addition to that, a lot of people are going to say, well, actually, the US dollar is more attractive. So why would I trade and invest in the stock market, which is in a different risk category? And instead of doing that, just keep my investments in cash, which is paying me very well, likely going to continue paying me very well because interest rates are high and they're most likely potentially going to increase again. So there's a lot of large institutions and fund managers which are lowering the exposure from this sector and increasing it to other potential sectors. So here, ladies and gentlemen, this is what exactly we're seeing within the market. Now, we've definitely got a signal here that the price is going to decline. It doesn't take an analyst or an economist or financial advisor for us to point that out to you. But what a lot of people are probably going to be thinking to themselves, even as I said that we've got a signal the price is going to decline, we can see continues to decline. What most people are probably thinking about is, where is the price going to go to potentially? Where can we place our take profits? Where can we aim at? And a lot of people use a setup here within the 2 hour time frame, because here you can really clearly here see each impulse wave. We can really place targets. We can really see where there's high volumes potentially within the market as well. Now, one thing that individuals definitely can do is look at this area here where we can see we found support resistance here, we found resistance here, and we found resistance here as well. So this is one option that individuals can take. People are probably going to think to themselves, well, actually the price is very close to that. It isn't close to that, ladies and gentlemen. That is 39 points away, 0.39% away. So anybody looking to trade intraday, and keep in mind that there's a lot of advantages to trade in CFDs intraday because you're not going to incur overnight risk, weekend risk, and swap fees. Then that's a very large price movement that you can take into consideration. The other thing we can take into consideration is it's moving back to our trend line here. So for example, we've moved back to it here as well. We're also very close to it here. So this is another scenario that we can keep in mind. If we're going to speculate decline, we can aim for that area. But of course, as it's going to decline, this will continue moving upwards. So most likely as the days progress, it probably will be somewhere down here. And that will also keep in line with higher highs and higher lows because we are still technically within an upward trend. The trend hasn't yet changed. We're looking at a strong intraday decline for sure, but we don't yet have a change in the trend just yet. If we're gonna, and that's not something up for debate. It's down to statistics. So something statistically needs to happen to the price in order for it to move into to officially be in a downtrend. So we're not yet in a downtrend. We're just very simply looking at a retracement so far. Of course, it can potentially develop into a downtrend, and that's something that we'll look at as well. So this is option. We looked at one option, we looked at a second option as well. The other option individuals can look at for sure as well is looking at the latest impulse wave here. So if we're looking at the latest impulse wave, which is here, if we are going to stay within a retracement, this is the area on the Fibonacci that points out retracements. So this line here, so basically at the 61.8. So a retracement, ladies and gentlemen, can find support anywhere in this area here if the upward trend potentially is going to continue. Now somebody's asked another question. I'll quickly read it. Okay, so it's a good question. Somebody's asking, where does technical analysis. So he's not referring to officially where there's going to be a downward trend. For there to officially be a downward trend in the short to medium term, we need to cross onto a lower low here. It needs to retrace and then break to another low as well. So not only does it need to have a bearish breakout, but it also needs to retrace upwards and then have another lower low as well. So forming a lower low and a low high. There we've got an official downward trend. Whether it's temporary or going to be longer term is a different question. But in terms of technically, in order for indicators to point to a downward trend, we need to trade below the 75 bar exponential moving average, which is this red line here, and also be trading below the RSI as well. So it's at that point where indicators will indicate a downward trend. So if we go back, an example of that is very simply here, ladies and gentlemen, this here. So we can see that we're trading below the 75 bar exponential moving average, and especially in this area here, we're trading between the 25 and 50 as well. That's the area where we're mainly seeing that sellers are controlling the market and the price is going to decline. Now we can look at other examples of that as well. This is a good example of that here, that the price is going to decline. We can see we're trading below the 75 bar and also trading below the 50 here. Another example of it is here. Keep in mind, this is a 2-hour time frame. We're not looking at massive, very long price movement that's going to last for 3-4 weeks. We're only looking at a 2-hour time frame here. So currently, we can see that intraday, we're looking at the price declining. We can see the PMI is supporting also that the price is going to decline as well. Definitely, the Federal Open Market Committee was extremely hawkish. Now, some people were shocked by this, whereas really people, especially traders here at HF Market, shouldn't be shocked by this because very simply, ladies and gentlemen, if you were following our analysis, this is something we've been talking about for a very long time. So if I go to news and analysis, ladies and gentlemen, I go to market analysis. This is something that we've been speaking about for a very long time. For example, here, inflation fears grip the market. There's a lot of things that here we continuously have been mentioning, which is indicating that the Federal Reserve is definitely still having very hawkish elements and factors within their rhetoric. So this is something that we continuously, again and again, are mentioning. Even this morning, hey, look here, Fed consider another rate hike. This is negative for the stock market. This was something that we mentioned this morning. We also had some targets for upward price movement, and we did hit those targets in the upward price movement. So if I put a day separators like this, we can see here that first we had upward price movement. So we hit our targets where that was mentioned in this morning's analysis. But since then we have declined. So that analysis this morning was spot on because it hit our upward targets, but also a decline, which is a very strong effect, domino effect, the ripple effect, should we say, of higher interest rates. So we've looked at targets now, ladies and gentlemen, which we can take into consideration. Now, some people may be thinking to themselves, what about, upward price movement? Where will we potentially see indications of upward price movements again? Because maybe some people thinking, the NASDAQ by 2024, the end of 2024, we may be looking at 20,000. We may be looking at 21,000 and so on and so forth. Now, if we're looking at the 2-hour, most likely it's going to be at the 61.8 based on indications. Okay, based on indications. Now, some people may say, why? Because we're above the 75 bar exponential, and we would be above the RSI as well, neutral level, so above 50. And what I've done is I've basically drawn a Fibonacci level between the high and the low of the retracement. If it didn't retrace and actually declined to a lower low, so for example down here, then you couldn't use the Fibonacci retracements, because this is why it's the Fibonacci retracements, to trade the continuation of the trend. If it's in a trend, it has to retrace, not correct, not see a lower low, because that's indications of a different type of trend. So if we're crossing above this red line, based on the 2-hour, that's an indication where potentially the price is going to start to see bullish price movement again. If we're going to see and look at, for example, um, for example, the 5 minute time frame, definitely still at the moment 5 minute time frames indicating downward price movement. Ideally, we would look at the breakout that we previously mentioned, so the breakout up here. A lot of people are probably thinking that's very far away. Ideally, I'd like to see retrace. I'd like to see an earlier entry point. That's absolutely fine. And what people can do is, as it increases and then retraces, back downwards, they can again use the Fibonacci levels to help them with the entry point. Now, because the price movement hasn't happened just yet, I can give them a different example of this on the 5 minute time frame. So actually, let's use a recent example. So here, for example, we have a retracement. Very simple. Here we have a retracement. We can see we've got a high here as well, and another high here. We're looking at all the lows are higher as well. So be very clear indications of upward price movements. I'm drawing between the high and the low of the retracement here to give us an indication of when the price is going to gain momentum again. And then again, we're at the 61.8. Now, some people use the 61.8. Some people are slightly more risk averse and they instead use the 65.00. That's absolutely fine as well. People want to alter the Fibonacci levels. It's not so much the Fibonacci levels, which is important. We're just basically using them to indicate this is enough momentum for potentially a trend to start to form. So if we're looking at this, ladies and gentlemen, this was the also the indication we looked at in this morning's market analysis. We can see since then the price increased by 0.36%. Again, more than enough price movement. Increased above the 123, 138, 161 on the Fibonacci as well. More than enough price movement for those individuals that look at intraday price movements. So if we see a retracement like this, but an upward retracement, let's say if the price retraces to here, based on this low and the high of the retracement, we can draw the Fibonacci levels again to give us further signals. Otherwise, another indication people may potentially consider, ideally you don't want to be overbought though here, if that is going to happen. Hopefully we'll move about out of that level. Is we've got the low here, we can trade, for example, the breakout. The only concern there, ladies and gentlemen, is that we've already had a very large price movement. So is a breakout really going to indicate a further decline? So, ladies and gentlemen, this is the NASDAQ. A lot of that will apply to the S&P 500, and you can see it definitely is applying to the S&P 500. Of course, there's correlations there, so people need to take that into consideration. Let's also look at a currency. Now, what I always say to individuals when they're looking at the currency is you should look at a currency as three different assets. A lot of people look at currency, especially beginners, they look at currencies as a single asset. It's not a single asset. It's three different assets, and we need to analyze it as though it is three different assets. Now, why is that? Because it is three assets. We've got, for example, the euro. So I need to analyze the euro as an individual currency. Then we got the US dollar. Again, something I'll analyze as an individual currency. And then we've got the euro USD, which is the third asset. So I'm analyzing it as though it's three assets. Now, it's going to be very difficult, especially for beginners, to analyze, to find enough momentum, to avoid that up and down scenario. If we have, for example, two currencies which are increasing in value, or for example, if we have two currencies which are decreasing in value. When that happens, there's a conflict. There's a contrast there. Within the market, a lot of people know it as a tug of war condition. So instead of that, there's benefits when you're looking at a well-performing currency and a currency which is, at least for the day or for the week, decreasing in value. So there's no conflict there. Now, there was, of course, a lot of strong price movement for the euro against the US dollar today. sorry, for the euro, and of course the US dollar was decreasing in value throughout the whole of the day until we had that PMI announcement. Whereas if we're looking at other currencies, for example, ladies and gentlemen, there was weaker price movement. For example, the pound, for example, the Japanese yen as well. Let's look at the Japanese yen. If we don't have it here, we can of course add it. US dollar against Japanese yen. There we go. US dollar, Japanese yen. There we go. Here we go, ladies and gentlemen. So this is something, of course, for us to take into consideration. Now, let's start again on our 2-hour time frame. Let's move these indicators on this line here. Let's add, just to start off with, the US dollar against Japanese yen. US dollar against Japanese yen, we can very clearly see here we're trading above the 75 bar exponential moving average. We also trade in at 69 and on the RSI. Keep an eye also in mind the RSI is on a period of 18, not at the default parameters of 14. We can see here we're above the 50, we're above the 75 bar. So we have indications there that the price is going to increase. We also trade in at a higher high here. So we should be cautious that it's not going to retrace back to that price because each time we have a breakout, it will retrace. For example, here we can see we broke, it retraced. When we look at the next breakout, it broke here, it retraced. So it's broken again, so we have to take into consideration potentially it may retrace as well. That's not a bad thing, it's just giving us an opportunity to enter at a better price. So if we switch to a 5 minute again, we look at the euro, the Japanese yen against the US dollar. Let's zoom in slightly so it's easier for everybody to see. We can of course use this low and this high here to indicate where we're going to see a buy signal. Now, we're very close now to seeing a buy signal. The buy signal, ladies and gentlemen, will be at the 61.8. So we've just now almost crossed above it. There we go. So we've crossed above it. So now that's a potential indication that potentially the price is going to increase. That's based on the indications, of course. What individuals also do, for sure, is a look at longer term timeframes to see if they're at an area of resistance. We're actually trading above the previous area of resistance and far below the next area of resistance. So this is, of course, something individuals can take into consideration as well. But let's also look at the euro against the US dollar. The reason I want to look at the euro against the US dollar is that, especially today, the spread was very low, ladies and gentlemen. It always has the lowest spread, but today we had a very low spread. Now we're just about we more or less actually have the neutral with a slight bias towards sellers controlling the market. So the US dollar increasing and the euro decreasing because we're just about below the 75 bar exponential moving average and we're just about below the 50 as well. We're currently at just, should we say, 47 mark. So just about seeing an indication that potentially sellers are controlling the market. We can see it's retraced as well. So again, we can switch over to a 5 minute. Let's get the euro USD onto our chart. So we can see it's retracing. What we can of course do is have here the high and low. So we can have the 61.8. But like I said, if people want slightly more momentum, so slightly later entry and more momentum because they're cautious that they're going to enter basically too early. Instead of having 61.8 here, they can of course make that 65. That's absolutely fine as well. So here, let's change that as well. 60, 65. So this is an opportunity as well. And we can see the entry point slightly lower. So if people are slightly more risk averse, this is something they can do. So option number one, they could trade at the breakout. There's slight disadvantages to that, very simply because it's a later entry and everybody will try and trade at the breakout. Whereas, big institutions always say you should avoid the typical entry point that everybody knows because this is where they'll try and catch you out. Instead of that, trading below before the breakout. So this is why people sometimes look at the 61.8 or the 65. Again, you can vary that if you wish. We haven't got a signal yet. If momentum gains again, this is something potentially that we may see. Let's also look at another setup here. Let's look at gold. So here we're looking at here we're looking at the Bollinger Bands. Bollinger Bands are pointing downwards. This is on a 15-minute. Even if we switch into a 30-minute and a 1 hour, we can see we're very clearly riding the stairs downwards on the Bollinger Band. So indications there that gold will decline. We've been trading below the 200 average, the 50 average. We're trading below on the MACD as well. There's slight divergence here, which is a concern. There's also slight divergence here on the stochastic oscillator, which is a concern as well for individuals looking to trade downwards, because that may indicate at least a correction, in which case a correction will move back to this level here. But momentum indicators, like the moving averages, like the Bollinger Bands, the RSI as well is trading very low. These are actually indicating downward price movement, very simply. If we switch to a 5-minute, we've got no indications that the price is actually diverging yet. We'll keep an eye on it, something we have to make a note of, because we saw it on the 1 hour. We haven't seen it on the 5 minutes yet, though. What we also can do, ladies and gentlemen, is look at if there's any support and resistance points, so any psychological levels for traders. And there isn't really, there's a price rejection point here, ladies and gentlemen, but not a clear support level. The major psychological level is actually here, ladies and gentlemen. And we've actually, this is a very strong momentum. We crossed below this breakout. We've crossed below this bearish breakout as well. So definitely indications there of potential downward price movement. It's just a question of how low does the price need to decline before it's a low enough price to entice investors to enter again at the lower entry point, especially certain regions such as federal institutions as well as private institutions in China, in Turkey and in India, and areas of the market of the world like these. So, ladies and gentlemen, that brings us to the end of today's live session. We've looked at active signals and entry points, and looked at where we don't have an active signal, but where there may potentially arise. We looked at currencies, we looked at indices and individual stocks. We looked at gold as well. This is, of course, something that isn't here to tell you when to buy and sell. It's not here to give investment advice. These are here for educational purposes. So we want to give as much educational material as possible in order for you to be able to be active as you wish within the market, but with confidence, with knowledge, with skill and expertise. And of course, you've got free access to a lot of educational material when you create an account with HF Markets. And in addition to this, if we've got individuals that have never traded before, we have strategy providers via copy trading. And this is something that you can also get access to for free. You can get access to viewing what individuals are trading, when they're trading, how they are trading it, what assets they are trading, at which prices, where they're placing their stop loss and take profits. Also, people can copy these strategy providers if they wish. So there's a lot which HFM apply and give access to both small, medium, and large traders as well. So that brings us to the end of today's session. Trade safe, trade responsibly. Keep in mind that anybody that is trading the S&P 500 and especially the NASDAQ, Intuitive will release their earnings data tonight, approximately at between 11 and 12 o'clock GMT plus 3. That will also create a lot of volatility within the market. Otherwise, though, ladies and gentlemen, enjoy the rest of your evening, and we'll speak again soon on our next webinar or on our next live session. In the meantime, goodbye and take care.